Hello and welcome to Livewire's Buy, Hold, Sell. I'm Grady Wolf, and today we're taking a deep dive into the small cap sector to find a selection of stocks that have a high growth runway heading into FY24. To do that, I'm joined by our experts, Tim Johnston from Tyndall Asset Management, Tobias Yao from Wilson Asset Management. Gentlemen, first up we have MMA Offshore, which provides marine services to offshore oil and gas industry. Now Tim, we'll start with you. Is it a buy, hold or a sell?
For us it's a buy. It has had a good run, but it is lagging its international compcos. The reason we like it is the fact that the supply-demand environment has changed enormously for MMA. It's a supplier of offshore vessels that support the oil and gas industry, but also now a new source of demand in offshore wind farms. Demand has rapidly outstripped supply. Prices are increasing enormously, and importantly, the supply response to bring on new ships is a multi-year story, so we see no supply response for a number of years.
Tobias, its share price has run 124% over the last year. Buy, hold or sell for MMA Offshore?
So I agree with Tim, it's a buy for us. I think the big debate in the market is whether, to Tim's point, whether supply comes on to meet demand in this cycle. We've visited quite a few industry players suggesting to us that if you're going to order a vessel now, it's going to take you probably more than 2 years to receive the vessel, and idle vessels cannot be reactivated in the current market. So it's a buy for us. We believe rates will continue to go up, which will benefit their top line and their bottom line.
Now, staying with you, Tobias, we have casino and leisure business SkyCity Entertainment Group. Buy, hold or sell?
SkyCity is a hold for us. We really like the New Zealand asset and the opportunity in the online space in New Zealand, but the regulatory uncertainty is keeping us on the sidelines, so it's a hold for us for now.
Tim, its share price has fallen 16% over the past year. Buy, hold or sell on SkyCity Entertainment Group?
It's a buy for us for pretty much the reason that Tobias doesn't like it. We think the regulatory risk is actually overstated in the current share price. The reason for that is the New Zealand Ministry of Justice did a review into anti-money laundering last year and have basically found no material issues for the casino group. So for that reason, we think the de-rating that's occurred is overdone. I think there's 30% upside just from the valuation multiple alone, and they're also at the end of quite a large capital reinvestment program, which is going to drive earnings growth from here also.
Next up, we have Viva Energy Group, Australia's licensee of Shell's fuels and lubricants, runs around 700 Coles Express stores and recently acquired On The Run Group for $1.15 billion. Tim, buy, hold or sell?
For us, it's a hold. We really like the business. We really like the management team. It's a high quality management team. They've executed flawlessly over the last sort of 5 years, and strategically they're very, very capable. And we do like the On The Run acquisition. The problem for us at this point in time is that the conversion of 700 stores to a new format will take a number of years, and whilst we do see that long runway of growth coming, I think it's a bit too early to pay for it, so it's a hold for us.
Tobias, its share price has lifted nearly 18% over the last 12 months. Buy, hold or sell for Viva Energy Group?
Yeah, so Viva is a buy for us. To Tim's point, the On The Run acquisition, in our view, is very strategic and it's very high quality, and we like the management team. We're backing them to execute. You know, over the next 10 years, we believe they could convert 700 of their Coles Express formats to On The Run. Now, On The Run generates 2 times the revenue per store as Coles Express, so that should underpin the growth for both top line, bottom line over the next decade. Now, over time, convenience retailing as a percentage of total business should go up, and that should lead to a valuation re-rate, given the refining exposure reduces and the earnings volatility reduces. So Viva is a buy for us.
Now, we asked our guests to bring along a stock with high growth runway. Tobias, I'll stay with you. What have you brought for us today?
Yeah, so my stock today is Megaport. Now, we've done really well out of it over the last few months because the chairman, Bevan Slattery, has come in, stepped into the business and introduced financial discipline and steadied the ship. The reason why it is still a buy for us is because we believe the new CEO, Michael, is of very high pedigree. He's had an amazing track record in the US, and he's very experienced in sales. So we believe he could rejuvenate the sales culture and the sales cadence of the business. The product itself is very good. The net retention revenue is still very healthy, even with the operational challenges. So we are backing the management team to continue to execute on this turnaround. So Megaport is a buy for us.
Tim, which stock have you brought for us that has a high growth runway?
I'm suggesting Strandline Resources. Now, this is a much higher risk proposition than the other stocks we've talked about today, but it does also offer the prospect of outsized returns. Strandline is a new producer of mineral sands. The reason I like the stock is, first and foremost, the commodity outlook for mineral sands is very, very good. The market's forecast to be in deficit within the next sort of 3 to 4 years as a consequence of existing mines sort of coming to the end of their life or seeing declining grades. So the outlook for the commodity price is very strong as a result, and that'll generate very good cash flows for Strandline. In addition to that, it's a 37-year asset life. It's a very large resource. The management team's looking into expanding the size of the plant and bringing forward a lot of that cash flow by increasing production, so another leg of growth. And then thirdly, they've got other mineral sands deposits around the world. We know there are other parties interested in joining them in and progressing those potential projects, and we think Strandline can do that on a very capital light basis, sharing the economics of the project without having to put capital into it, so a third leg of growth. At the moment, you're getting an opportunity to buy it primarily because it's having a few commissioning issues in ramping up its first project. Importantly, none of the issues that are occurring are uncommon in mineral sands, and none of them are insurmountable. So the share price has underperformed quite dramatically in the last sort of month, but this is an opportunity to buy what looks to be a very promising project with a long growth runway at a very attractive price.
Well, absolutely. You heard it here first from our experts, and that's all we have time for today. I hope you enjoyed that episode of Livewire's Buy, Hold, Sell. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content every single week.